Hey, what's up, guys? Welcome to Tax Tip Tuesday, where we share real estate related tax tips. And some of these are going to be focused on your personal residence, what the tax advantages are there, what the tax loopholes are there, all that kind of stuff. And some of them will be focused on real estate investing, whether it's long-term buy and hold rental properties or fix and flips. And today's tip is going to be focused on real estate investing and more specifically buy and hold rental properties. And what we're going to talk about today is a cost segregation study. And I'm going to pull up some slides here. These are not advanced. We'll get more high tech with these as we go, but this will give you the basic information here. A cost segregation study has to do with depreciation, which if you're investing in real estate or just want to invest in real estate, you've probably heard of depreciation, the magical expense, the phantom expense that you're not actually paying for. And all it is taking the value or the purchase price of the home that you got, dividing it by a certain number of years, and giving you an expense for that every single year in your taxes year after year. So let's just walk through a random example here. Let's say you purchased a rental property for $250,000. All right, the first thing you have to do is separate out the land from the improvements or the building. And the way you're going to do this, you're going to go to the county auditor site, see what percentage they allocate to land, do the same thing on your purchase price. It's typically going to be between 10 and 20%, not always, but typically. So let's just say that 10% was land value. All right, the remainder was improvements or the building itself. So $25,000 in this case is land that cannot be depreciated. The improvements or the building portion is $225,000. So your depreciable value is $225,000. And the next thing you're going to have to look at then is how many years is a depreciable life. So you got your depreciable value of $225,000. The depreciable life is just how many years you depreciate it over. If it's a residential rental property, that's 27 and a half years. If it's a commercial property, that's 39 years. Right? So you just buy this single family home for $250,000. It'll be depreciated over 27 and a half years. Right? So your depreciable value is $225,000 divided by 27 and a half years, which means your annual depreciation expense, this is an expense you're going to claim on your taxes against your income, is $8,182. Right? And again, this is a phantom expense. This isn't something you're actually paying for, which is great. It's just year after year right there and reduce your taxable income. But there can be a way to supercharge this number, right? And that's with a cost segregation study. And essentially all a cost segregation study is it's going to break down a home into all its various components. So instead of just saying the value of the improvements or building is $225,000, it's going to say, no, what's the value of the foundation and the roof and the doors and the windows and the flooring and the appliances and the electric and the plumbing and the trim and all these million different things that are involved in your house is going to break them all down separately. And here's why that's so important. Because there's something called bonus depreciation. And bonus depreciation allows you to accelerate that number. But it only applies to property that has a useful life of 20 years or less. All right, so that 27 and a half year rental property is not going to qualify for bonus depreciation. But when you get this cost segregation study, you're going to be able to break down that individual parts, and a significant amount of those parts is going to qualify for this bonus depreciation because its useful life is going to be 20 years or less. So like the electric, the plumbing, the appliances, the flooring, there's a bunch of other stuff that all of a sudden is going to go from just being standard depreciation 27 and a half years to qualifying for bonus depreciation. And bonus depreciation before 2023 allowed you an immediate 100% write-off. Right? So let's just say that they allocate $15,000 to the flooring in your home. That $15,000 prior to 2023 could be immediately expensed as depreciation instead of spread out over 27 and a half years. That does change in 2023 to 80% instead of 100%, and then it goes down from there. As of now, Congress can vote to extend the rules the way they were prior to this year, and I think there's a good chance they will. If not, it'll be 80%, but that's still a significant increase in the amount of depreciation you can take. All right, so just looking at some examples, remember the previous scenario, we just divided that $225,000 divided by 27 and a half years, you get an expense of $8,182. In our new scenario where they're breaking it down and getting the bonus depreciation, you could easily get as much as $75,000 deduction. All right, and what that's going to do, let's just assume that your total effective tax rate, your IRS and state taxes combined are 25%, which is right near the average for medium to high income earners. Your savings just from doing a cost segregation study is going to be $17,000 in tax savings. And honestly, this is a bit of a conservative number. I just did a tax return for someone a few months ago that they saved $22,000 on their tax return by doing a cost segregation study. They went from owing $21,000 to getting a $1,000 refund, doing nothing but a cost segregation study. So this is a very real and very powerful way to save taxes, to take advantage of the tax benefits of real estate. And you can, this is something, so this person I was doing their 2022 taxes in March of 2023, and they were still able to go back and get a cost segregation study done now to impact those 22 taxes. You can even go back further to previous years. However, if you do that, it's going to be more involved in the tax return process. The expenses are going to go up, right? But it is possible, but you want to do it as quickly as possible. So if you're going to buy a rental property here in 2023, make sure you're talking to your tax advisor now and through the end of the year so you can get that cost segregation study in place. Now let's go over a few cons with this, or at least things to look out for. Number one, it does cost money to get the cost segregation study. And it used to cost significantly more money. Typically, you'd have to hire like an engineer, and he'd go out to the property, comb through every little detail to come up with these numbers. I saw people pay $5,000, $10,000, I even saw $30,000 in expense for these cost segregation studies. Now there are online companies who break this down remotely for you just based on some documents that you send them. So the cost, I've seen it anywhere from $500 to $1,000 to $2,000 for these companies that will do that remotely. So still some costs involved, even $2,000. But again, in that conservative scenario before, you're saving $17,000 in taxes by doing this. So well worth a little bit of cost there. The second thing to look out for is related to the one above. You do want to make sure that you're having a qualified company do this for you. There are no technical rules in place as far as, you need to be certified to do a cost segregation study. So there are some people who are tempted to get cheap and say, I have this tax professional who said he'll just write it up for me. I would not go that route, because if you're ever audited, the IRS will want very good proof that your cost segregation study is legit and that they can trust those numbers. And by having an actual cost segregation study company do it for you, that's much better proof than, my tax guy who's never done anything like this in his life just went ahead and broke it down for me. So don't get cheap on that. Spend a little bit of money to make sure that it's done properly. And the last thing to be wary of, and this is a big one, is for most people to take advantage of this, they have to have the real estate professional designation. And that's going to be a whole tax tip Tuesday video all by itself, because this is so important in the real estate investing world. But essentially, the tax professional designation allows you to take losses on your real estate investing against your other income. And without this bonus appreciation really isn't of much value to you. So, and long story short, to get this, basically real estate has to be your primary form of work. So if you have a full-time job and you're working 40 hours a week, you'd have to be spending 41 hours a week or more in real estate to qualify. And typically the IRS is not going to believe that you're spending 80 plus hours of total work every week. So make sure you do qualify for real estate professional. Again, talk to your tax professional. We will have a video on this very important topic at some point. But if you do not qualify for that real estate professional designation, you're probably not going to be able to take much advantage of a cost segregation study. All right, but for the rest of you, for those who do qualify, this is a very powerful way to save taxes. It's one of the biggest tax tips out there for real estate investing, and it's absolutely something to look into. Tune in next week. We'll have another important topic here with Tax Tip Tuesday. If you like this, if you got value with this, be sure to like and subscribe, and we will see you next week.